Welcome, everybody. I'm Nancy Dupre, and today I have a guest speaker who is a lender, Grant Norris, with Cross Country Mortgage. And our topic is going to be what is going on with the lending environment, interest rates, and everything mid 2025, middle of the year. So, welcome, Grant.
Well, thanks for having me, Nancy.
Thank you for being here
Pleasure
today.
to be here. Yes.
Yeah, I'm going to ask the question that most of our buyers and our sellers want to know, and that is, what is working in our current environment? We've been in, these 6.5 type interest rates for about 3 years. So, what is actually working in our marketplace?
Yeah, let me touch on kind of big picture stuff, and then I'll give you some tactics that we're using. We have been in a relatively high mortgage interest rate environment for about 3 years. You're right. I've been doing this for a very long time, and typically you'll have a run-up in interest rates, and they'll kind of flatten out a little bit, and then the economic indicators will change and rates will come back down. And typically, maybe 6 months, 9 months, you're kind of in that high interest rate environment, and then things kind of come back. This is a very different environment where we've been there now for 3 years. We've had little dips, but every time we've had a little dip, rates have gone back up. So yes, we're sitting around interest rates at roughly 6.5%, some a little lower, some a little higher. And let me give you a program that we're actually using for a client right now. We just put them in escrow last week. And this is called a buy-down program. The technical term for this particular program is a 2-1 buy-down program. So what we're doing is the base interest rate for our borrower is 6.5%. Now, if the borrower had to pay 6.5%, his payments would be higher than what he's comfortable with, and he wouldn't have bought this property. Okay, it was just a non-starter. Payments were too high. So what we did was it's called a temporary buy down, where for the first year he'll get the payments based on an interest rate of 4.5%. Second year be 5.5%, and then years 2 through 28, the remainder of the term will be at 6.5%. So once we brought the payments down to the 4.5% level, it brought the payments into a range where he said, yes, I want to go for it. So he approached the seller, worked with an agent, and they put the deal together. The way that it worked on the seller side was the cost of that buy down to bring those payments down, this was a $615,000 loan, was about $14,000. The way that the buyer got that money is the seller gave him a credit for $14,000. The agent actually negotiated a little bit more and got him a $20,000 credit. So he was able to get the reduced payments, the buy down, and $6,000 more for the rest of his closing costs. Ooh. Advantages on both sides. Number one, biggest one, of course, to the buyer, it brought that payment down to a level that he's comfortable with and says, yeah, now I want to buy the property. On the seller side, the seller didn't have to do a sales price reduction. The seller gave a $20,000 credit. So he kept the price at the list price at $770. The seller's really getting $750 because he just gave the buyer $20,000, but that was acceptable to the seller. What wasn't acceptable to the seller psychologically, was to lower the price down to $750 and maybe even have to go lower.
Right.
So
right.
We satisfied needs, I think, on both sides. The buyer was brought into a payment level that he was comfortable with.
Yes.
The seller didn't have to do a price reduction.
Right. Yeah, it's perfect really for this environment because what we're actually looking at in that price point is probably a condo, would you say?
This one's a single family home.
This is a house?
Yeah.
Okay. So you might have had a seller who initially wanted 900,000 for the house, let's say, and they're willing to, drop the price down to $770, but they're not willing to go any lower.
Right.
But they will do something for the closing costs to help buy down the rate for the buyer.
Right. So what
Yeah.
so in effect, as I said, it's a win-win. The seller didn't have to do a price reduction, still got a net price at 750, which he was happy with. The buyer got an interest rate and a payment that he was happy with. Escrow's open. We're about ready to issue an approval and move forward with, roughly a 30-day escrow.
Wonderful.
But that wouldn't have happened unless the agent had some coaching and some information from somebody like me to say, this is how you can structure this where you get a win-win.
Right. You got to have the right team working for
Yes.
you, whether you're the buyer or the seller, to come up with these problem-solving strategies
Yes.
to deal with this market.
Yeah,
Right?
and
It's
it
not
takes-
just,
it takes-
coming out of.
And it takes a special agent, and Nancy and your Sotheby's is
Thank
the
you.
tops in
Yeah,
my
thank
in
you.
my opinion. Yes.
Yes, and we work with our lender partners to get our clients what they're looking for. And in this market, while people are very, hesitant because of the interest rates, there's still advantages to buying in this market. As I mentioned before, you might have a seller who initially wanted $900,000 for their property. They've already done price reductions. So at $770, it's a great deal.
Yeah.
So oftentimes we're finding our buyers are saying, that's a fantastic price, and it's the actual property, the precise property that I want, that in a lower interest rate environment, that could have been a $900,000 property.
Exactly.
Right?
Exactly.
Yeah,
Do you want me to touch on that a little bit?
absolutely.
Okay.
Yeah.
So there's pros and cons to low interest rates, right? So the buyers that bought properties over the last 2 or 3 years and got rates in the sixes or so, there's inevitably going to be a period of time where interest rates come down below that where they can refinance. Okay? And if they waited 3 or 4 years, the property's gone up in value. And they'll have that refinance opportunity. When interest rates come down, and we can remember the extreme examples of this in 2020 and 2021, when interest rates were at historic lows, and every property had multiple offers on it. Every buyer was fighting against 2, 3, 4 different offers, and the prices just getting bid up. It was a supply and demand imbalance. So right now you have the buyers that, I think we're going to look back a couple, 3 years from now, the buyers that bought during this time period from a long-term standpoint, 5, 10 years in property value, I think are going to be really, really happy that they did
Exactly.
it. Yeah.
I agree with you entirely.
Yeah.
Because what happened in recent history, like you said in 2020 and 2021, is yes, we had lower interest rates, but it wasn't 4 or 5 offers. We got 17 offers on property. It was crazy.
It was crazy.
And people were bidding them up $100,000, $150,000 just to get the property during the low interest rate times.
Right.
But you're paying this high price because you have to.
Yeah, it's
Now you have all the negotiation. We're seeing price reductions
right.
on the seller side, and then they're willing to negotiate and do what they can to help you get a lower interest rate loan. It's a great time actually to be a buyer.
This is one of those periods of time, especially in Southern California real estate, where the buyers have some advantage.
Yep.
Right.
Yep. And we're even seeing appraisals come in
Yeah.
higher
Yeah.
than the contract price, which is exciting.
Yeah, we just got one.
Yep.
Yeah.
Yeah, we're seeing that, meaning you're walking into equity.
You're walking into equity.
Yeah, and you're not going to get that just any time.
So for the people that are listening to this, or maybe know people that are, I need to wait for rates to come down before I can get into the marketplace. Again, it's a mixed blessing. Rates will come down, you get a lower payment, but you're going to be competing against more and more people to buy that property. So what does that do? Number one, it's going to push the purchase price of that because there's more demand. Number two, you may not be one of the lucky 7 or 8 people that get to buy that property. And then you have to move on to another one, and then there's some fatigue with that too.
Absolutely.
Yeah.
In that kind of market, a lot of people get fatigued and they actually get pushed out of their ideal neighborhood.
Yes.
And they end up let me just buy something. And then they buy in an area they don't like as much.
Yeah.
Yeah.
So in this case, this borrower, his interest rate and his payments are going to be based upon 4.5%. And he knows it's not a variable rate loan. It's a fixed rate loan that we took, and we brought the payments down. There's no balloon payment, and it's not variable. Everything's fixed. And he's of the belief that, like most of us, within about 2 years or so, we'll be looking at a more favorable interest rate environment, and maybe he'll be refinancing into a straight 30-year fixed rate at, say, 5%.
Right.
And for somebody that's going to live in the house for the next at least 10 years, that works out perfectly for him.
Perfect. Is there also such a thing as a 3-2-1
Yes.
buy down? What's that?
3-2-1 buy down is just a little variation on that. So if we're starting off at an interest rate at, say, 6.5%, this would bring the interest rate and the payments down to 3.5%. Okay, and then you would be 4.5% and 5.5%, but that requires a bigger contribution from the seller.
Okay.
In this case, the 2-1 worked for our buyer and the seller, so we just stayed with that. But yes, you absolutely have the ability to do it's called a 3-2-1, and it just costs more. Again,
Okay.
it's a seller contribution. The buyer can't pay for that. It has to come from the seller.
Just as an example, if somebody had $1 million loan, what would a 3-2-1 buy down cost?
That is something I need
Okay,
an
you
Excel
need to-
spreadsheet
okay.
for.
Yeah.
We have a very handy one. We just plug it
Okay.
in and
All
it
right.
calculates it.
I'll have to call
It's
you
not
later.
a very straightforward calculation, but I can get it for you in seconds.
Great, great. So as long as you have a seller that's agreeable to help with the closing costs and buy down the rate, we can talk about options for the buyer.
Once you open up that door, because not every agent talks about this, right?
Yeah.
The vast majority of agents will say, you need to reduce your price. You need to
Right.
reduce your price.
Right.
You need to reduce your price. If you turn the conversation around and say, look, the market's a little soft and you're going to take a little bit less for your property, but we're going to restructure this where instead of just reducing your purchase price, we're going to give a benefit to the buyer to where he can get more favorable financing. That'll attract more people and help you sell your property faster.
Sounds good. And to some of the young first-time home buyers out there, it's always difficult to buy your first property.
Right.
So what do you say about, nah, I'm just going to rent? It's,
Oh, they're just going to rent.
Yeah. Rent for
there-
3 more years versus
Yeah,
5.
that never works. It never works. The property values go up, and I've had clients that have said that, and I won't say it never works, but it doesn't typically work out very well.
Right.
One of the first-time buyers will typically have maybe a couple challenges. Maybe they don't have enough income right now. That's understandable. Or they don't have enough down payment. And there's a lot of confusion about down payment. They do these surveys, and on the real estate side and on the lending side. And first-time buyers, especially the generation that's coming out right now, I think the last one I read said something like 60 or 70% of those potential buyers thought they needed to put 20% down to buy a house. Wow.
Yeah.
Wow. I mean,
Yeah.
that is really a high number.
They do think that, and then when I tell them or let them know that actually you don't need 20%, you can get in with 5, 10, or, they often object by saying that, well, then I got to pay PMI. So
Yeah.
how do you deal with that objection?
There's pros and cons to all this, right? So if you don't, let's take the difference between a 10% and a 20% down, for example. So at 10%, there's PMI insurance or something equivalent that makes the interest rate higher, okay? And let's say it's $1 million house, okay? So, 10%, an additional 10% to eliminate that mortgage insurance is $100,000. Not everybody has an extra $100,000 to put into a house. So you're spending $100,000 to relieve yourself of PMI, which is going to cost you maybe $300 a month.
Right.
Yeah, it's not. I've
So it
sketched
could
out
be
those
very
numbers.
worth it
Yes.
to do the PMI, get in, build equity,
To people that haven't bought a house before or not familiar with it, they think of PMI or mortgage insurance as a bad thing, okay? From being in the industry for a long time, I think of it as a very positive thing because until PMI was invented, everybody had to put 20% down, and the amount of houses that sold and the appreciation was much lower. Now with PMI, you are going to pay a little higher interest rate, and you're going to pay an insurance premium. It's not crazy. It's a few $100s a month, but that allows you to not have to come up with that much larger down payment. And there's a few, digging even deeper, there's a couple programs that we use through Fannie Mae and Freddie Mac that only require 3% down for first-time buyers. And in a lot of cases, they get preferred interest rates too. And then you have traditional 5% down. You have the FHA program. FHA program, 3.5% down payment. It's been around it was part of Franklin Roosevelt's New Deal. It came out in 1935.
Yes.
It's been around forever. And FHA will do loans now up to almost $1.1 million
Wow.
with 3.5% down.
Great.
Yeah. So this type of things that we're talking about, because we're in the industry, unfortunately, this new generation, the word's not really getting out to them. Now, if they sit down and talk to you or they talk to me, we'll provide them with this information. In a lot of cases, it's a game changer because going from thinking that you had to put 20% down or $200,000 on $1 million purchase to 3.5%, is a big difference.
Big difference, yeah.
Yeah.
And a young person could also purchase something like a duplex and rent out half
Yes.
and live in the other,
Yes.
have that working for them as their first property.
A couple other
Yeah.
advantages in those low down payment programs for first-time buyers is that all the down payment can be from gift. So if you don't even have the money yourself or you only have a small
Right.
portion, you can get a gift from a family member, and that's perfectly acceptable.
That's a great idea.
Yeah.
I'd love for more families to hear that because there's a lot of equity that's tied up in homes that have been owned by the family, and to do a cash out refi of
Right.
$100,000, for example, is possible.
It's possible. You could do a cash out refinance. You could do very popular product right now is the home equity credit line, the HELOC.
Yep.
Okay. These are ways, kind of digressing just a little bit, but these are ways that if you have equity in your property and you want to take it out, that you could give it to, your child or a family member to help them buy a house.
Absolutely.
Yeah.
Yeah, I see a lot of situations where grandma has a house and, grandma or grandpa has a house. They've been in it for 50 years, but the kids have kids and they're still renting.
Yeah.
And this would be a great opportunity to help the whole family and create generational wealth by, potentially doing a HELOC, home equity line of credit, to get some money out of the original house and help them buy their first townhome or house.
Yeah, well, think about the multiplier effect, right? You've got the old elder generation that has a house that's maybe free and clear,
Yep.
and you're using the equity in that property to help another family member buy a house. So now the family has two homes instead of just one. And as the market rises on the value of two properties and not just one.
Right. Great.
Yeah.
Well, I love these strategies, Grant. It's good to work with you.
Good to work with you, Nancy.
And we will continue to be out there helping people in 2025.
Yeah, thank you for having me. It's a pleasure.
Thank you.
Thank you.